Hello, and thanks for joining us today. I'm super excited you could be here. So, today we're talking about how to get your business to grow faster with capital, but how do you do it without relying on traditional banks? Like, what's the easiest and fastest and best way to get money where you're not trying to rely on this cumbersome bank process that takes forever to get the funding that you need? And to have this conversation with us today is Steven Edisis. Now, he's actually the founder and CEO of Dynamic Capital, and they're a revenue based financing firm that provides fast, flexible working capital, business lines of credit, and they also offer finance solutions for small and mid-sized businesses, all different kind of options. So they're driven by a mission to empower entrepreneurs overlooked by traditional banks. And actually, Stephen launched Dynamic Capital back in 2013 to deliver founder-friendly, non-dilutive capital that aligns with real business cash flow, not just based on credit scores, which gets so many business owners denied. And actually based out of Miami, Florida, and he leads the company's strategic vision, and he also leads their growth while sharing insights on business financing, on leadership, and entrepreneurship through social platforms and the Steven Edisis Show. So with a background that includes education at the University of South Florida, I'm a USF fan, because I'm right here in Tampa.
Well,
Steven has built Dynamic Capital into a trusted partner to thousands of businesses across the U.S., known for a transparent service and rapid funding turnaround. Steven, what's up, man? Thanks for joining me today.
Ty, thanks for having me. It's a pleasure to be here.
Yeah, I'm excited, man. USF, you're up in Jacksonville and Miami, it's all things Florida, and I'm a huge Florida fan living down here for
It's appreciated
sometimes.
Florida here representing in full effect. So yeah, thanks for having me, Ty. I'm super excited to be here and introduce myself to you and your guests.
Yeah, I appreciate it, and I appreciate you coming on. So let me ask you something. When you started Dynamic, what is the main problem that you sought out to solve, and is that still like what you guys are working on solving today?
So the problems that the small to medium business owner had back in 2012, 2013 are the same as today. Your traditional financing, your bank and your funders do not want to, or can't qualify for their small box. Most mom and pop business owners, Main Street USA, they either don't have three things. They either don't have the credit score to qualify for a traditional bank loan or advance. They don't have the equity or the security to actually securitize the loan. And third, here's the kicker. No matter if you do have both of those, most American business owners, the last thing they want to do is pay taxes. So they have a very smart accountant who takes their net on taxes as close to zero as possible, possibly even carrying over a loss, which your traditional bank is going to look at your net. Conversely, revenue-based funders, merchant cash advance, alternative business funders, we look at the gross deposits of the business. We understand how the revenue comes in and how it leaves as far as expenses. And ultimately, we can provide up to 14% of your annual gross sales versus looking at your net.
So I think that a lot of business owners hear about this kind of funding, that it's fast, that it's easy, that it's not based on credit, and they immediately have doubts on, does it really work like that? So how can revenue financing successfully work where credit's really not a main driven factor when you know that the big banks they're just driven based on like historical performance credit wise? So what is the difference with revenue financing where that's just not really a necessary main factor to look at when we see it with the SBA loans and so many other kind of mainstream financing?
So again, everything that you're talking about, SBA loans, bank loans, they're Fed backed. So they're going to have very stringent restrictions when it comes to credit score. 700 plus is get you in the door. Doesn't actually get you the approval, but it gets you in the door. Well, our business owners, typically they have 2, 3, 4 credit pulls a year that strain their credit score. So we look at the strength of the business. If the business has been around for 6 months or greater, has strong revenue, strong leadership as far as the owner itself, we'll go ahead and step in and start providing funding and get them the roadway to maybe get to the bankable product. But in the meantime, we're going to allow them to actually have the same experience a larger business owner has so they can get some capital. Because most business owners, and I'm sure you probably agree with this, Ty, started in either their basement or their bedroom. And although they're doing $50,000, $60,000, $100,000 a month in gross revenue, at no one point did they ever have that lump sum. So what we're doing is we're providing $40,000, $50,000, $100,000 in one lump sum to an entrepreneur to let them to actually implement the strategies that they had in their business plan versus white knuckling it and juggling money from the right pocket to the left.
Yeah, and it sounds like you're working more on earlier stage businesses because what I hear from a lot of people is that hey, look, for a bank to lend to me, I don't need the money. And when you hear that too, I mean, what they're ultimately saying is like, look, these guys only lend to me when I'm so big that if I was so big, I wouldn't necessarily need the money at that point. So, are you helping a lot of people then? Because you said 6 months is, are you helping a lot of the earlier stage businesses?
So that's a unique thing about myself and Dynamic Capital. I don't have any credit facilities, so everything is in-house funded. So we're not restricted by who and what we could advance to. So what I'm talking about that is I'll step into a strong business where typically they're looking in a revenue-based side 1 to 2 years in time in business. I'll step in at the 6-month mark, identify a strong business, add some capital, add speed and velocity to their growth. So this way, by the 1 year, 2 year mark, they're actually a bankable product than a revenue-based or alternative business funder.
So respectable. I mean, like even people that are in the revenue space, like here's what I think is interesting. Even the people in the revenue space, they want to be at businesses that are 1, 2, 3 years in business. They want to be lending 250, 3, 4, $500,000. That's what they're trying to target. But you're describing 50, 100, $150,000 loans, and I know that's not all you do, but you've hit into something. 6 months in business. So this is interesting because I don't know if I've ever met a revenue lender that focuses on these earlier stage businesses or that talks about helping somebody even, pre-year 2 to get to a point where they can get better financing in year 1 or 2.
Ty, our bread and butter is the overlooked and underserved marketplace. We really originally started because, again, we're private funding, right? So there's no HUD, there's no guaranteed of, so you could deny someone at any given time by race, color, or religion. So what happened is when I first started doing this, I saw quite a bit of files getting rejected by race and color and by religion. So that's how we originally started opening up our own platform. And once that came running, and then the rest was history. We're preaching. Over the past 13 years, we're talking about 15,000 unique business owners to the tune of $1 billion. But how we started and how we still stay and maintain our position is on the overlooked and underserved marketplace. People who are automatically getting denied in either phase, as long as the business is strong, the merchant who's actually directing it is strong, and our common sense underwriting will support that.
So who's your target demographic? Like who are you going after, let's say, time in business revenue wise?
So, if look, in a perfect scenario, you want someone who's been through multiple administrations, so they know how to navigate through different financial climates. But at the end of the day, what 1 year time in business would be terrific. I could get a quick snapshot. We'd love to serve the service-based industries, whether you're the subcontractors, your flooring guys, your roofing, people who have multiple projects going at the same time, who need a couple of dollars to close that project up and get that big payday. People who have delayed receivables, right? Someone who's 30, 60, or 90 days to their client and they need additional capital to kind of step in, we'll go ahead and do that. I'll give you a good example, Ty. Today, here's a completely different scenario. We have one of our clients. They are a engineering firm by nature. They specialize in government-backed contracts. During all this shutdown and closing, they are delayed on their payments. It's government-backed. I know they're getting them. So I went ahead and dropped $400,000 into the account today just to maintain for the next 30 to 45 days. So before he gets the big government contracts and payments through. So we do all sides of the spectrum. We do everything from restaurant, retail, service, all the way through some of your bigger industries, trucking, transportation, logistics, and everything in between.
So a lot of different industries. We talked about time in business. And what is your minimum loan amount? What is your highest loan amount?
So look, we like to stick around $25,000 is going to be our minimum. And then you typically would cap out at about $3 million on our advance.
Now, wow, that's crazy.
Understand this. Our process, I know it sounds crazy. We could provide, if we have a willing participant, someone who needs capital, they put the application, the banks in the morning, I could have this whole thing turned around and funded by 3 o'clock this afternoon. It's that fast and that rapid and that's what people pay for. Because my business owners are not the desperate type. They have an opportunity that's sitting in front of them. that needs capital within the next 72 hours. And we here at Dynamic Capital, we move at the speed of business. So if you go to a bank, although you're bankable, that opportunity highly likely is not going to be there in 12 weeks. And that's the industry that I serve.
And you guys are direct funders, you said, right? You're not brokering it, you're direct funding the stuff that you're funding.
So Dynamic Capital is my forward-facing brand. Majority of the underwriting is done underneath my own roof. So if I like it, I'll keep it on balance sheet. If I could get someone a better product off balance sheet, I'll do that. Or if it's got a little too much hair on it, I'm going to put it on the street to someone else, to a higher risk funder than myself.
Oh, wow. So you're like a one-stop shop. So even if I come to you and I don't meet your criteria, then you've got backup options and backup options that could potentially help me as well.
So I've been doing this for the past 14 years, as I said, and I have the relationships with the top private funders on the planet. Most of them don't even know, most people don't even know their names. So in the event that I need a secondary or tertiary platform, it's easy access.
That's phenomenal. So it's fast. What's the underlying process like when somebody comes into you?
So typically people well, the first thing that you have to understand, Ty, everything that we do is, I call it like almost seat to table. I don't have any outside sources no brokers. Everything we work with is agent driven. So again, we're not going to be commission driven. We're performance based. That's the first thing my merchants know. So they'll go ahead, they'll identify a true need and purpose for the capital. Once that's done, then we'll go ahead and bring the application. We'll bring the banks in. And then I'm really a fintech company at the back end. So once everything comes in, everything's automated, processed, credit, OCR technologies, reading banks. And, we have that file from the time it's coming in to time it's submitted, 3-4 minutes, 5 minutes. And then we have an offer back to my clients with some options within typically 45 minutes to an hour from submission. If the client is agreeable, they like the rate, they like the term, they like the dollar amount, all they have to do is say, yes, we issue contracts, DocuSign, basic bank verifications, and they're funded.
Wow, it's that fast.
It's that fast. And, look, it's funny you say this. My wife would say, who's that desperate to take our money? I said, hon, desperate people don't pay back, and we don't put our gold on sinking ships. We look for smart entrepreneurs who could take our capital and grow with it, right? We're talking about someone who needs my money just to put it in the bank. It's someone who could take our capital, has a specific purpose, and then pay us back, and then we do it again.
So when you look at revenue as your primary driver for approvals, what are you looking at? Like when you're looking at the bank statements, let's say, merchant statements or whatever you're reviewing, what kind of criteria you're really looking at to evaluate if this is a smart entrepreneur that you think can take the money, deploy it for the right reasons and grow the business?
Well, the banks, the thing we like about numbers is because they can't speak, therefore they can't lie. They tell the truth, right? So the first thing I'm going to look at as far as the deposits. How many? Is there a multitude? Is it one client they're working with on a monthly basis, or is there 30, 40 unique deposits? That's going to kind of help me determine risk factor. Now, if that 1 or 2 deposits a month is coming from a government contract, that alleviates my risk. So that's a couple of things. That's the first thing I'm going to look for is number of deposits. Then we're going to look at strength of the bank. Yes, you may be doing large dollar amount as far as gross monthly deposits, but how much are you actually keeping in the account to support the business on a daily and weekly basis? Then I'm going to look at your debits. Are you living through the account? Okay, because some people do, and we can still fund you that way, but you're going to put a little higher risk on it, or is your bank's clean, meaning the only debits and expenses I see from this account are business related. Then I'm going to look at NSFs, meaning, did your account ever go negative? Did you could not support a payment? Negative days. And then from there, we're actually look at business type, the merchant himself, because again, yes, we look at the strength of the business, but I want to look at the merchant because they're the one that's actually making the decisions on behalf of the business. And then you put that all together into an algorithm, and it bakes up a nice little rate and term and dollar amount that we're able to provide for you.
Yeah, and I think that helps. I think it just helps for somebody because a lot of people don't know that. It helps a lot to know that they're looking at revenue, not credit, primarily. And of course, a lot of other things tie in, but to know specifically what they're looking for in revenue, I think is even further help. Outside of that, like what are there other factors? Because does credit not looked at all, or how much of a factor really is that? Does it factor into approval? Does it factor into the amount of money somebody gets, the rate? Does it not factor it in at all? Like, how do you look at credit and other factors like that?
That's a really good question because everyone looks at it differently. Now, on our balance sheet, we're pretty common sense. So credit score may be pulled because of utilization. Credit score may be lower because of delayed payments. Those are not the same. Okay. Now, if a business owner is putting inventory on his credit card and that's a little elevated, which is pulling down the score, we can understand that. Now, if his trade lines are delinquent, that's a different type of risk. So we're going to look at each of those differently. Does that make sense to you, Ty?
Yeah, it makes sense. You're not looking at a score. You're looking at really what makes the score up. Because I've seen, for example, I've seen people with 500 scores just because their utilization is high. Well, they need more access to money to be able to fix that, but they're still paying everything responsibly versus a medical collection causing the score to go lower versus, being late right now on a current credit card payment.
Here's something completely on the opposite side of the spectrum. About a year ago, everyone's credit score was inflated because they had their student loans that they weren't actually paying, which were reporting as current and on time. So people had these inflated credit scores, which we knew and understood. So we kind of managed that into our risk management as well. And then you'll see this year, you'll see everyone's credit score took a hit who were not paying back their student loans. And that's just a little innuendos that you can understand when you're back and you see all these files and you know what's creating the high score or the low score.
Yeah, I think that's interesting you even bring that up because, like, do you see those fluctuations with FICOs as FICO changes their model? Because I think like one of the most recent ones is like collections, medical collections. I don't even think calculate into FICO score. So do you see that as they make these kind of adjustments to the FICO models and on your end?
We're constantly so the credit score is a very difficult thing to actually pinpoint what created what. So the
Yeah.
number itself. So we kind of, like I said, kind of the numbers one thing is a basis, and then we're going to look at what actions caused the score to be where it is.
Makes sense. Makes sense. And the other thing I think is interesting is I think the biggest thing I find entrepreneurs want are credit lines. Right? Everybody wants a credit line. And that's like one of the hardest things to get. Usually you've got to be able to have really good credit and meet like a lot of criteria to get into like an SBA cap line or something like that offered by a bank. So what kind of products do you guys offer? Are they advances? Are they loans? What kind of options do you have?
So we've got a full catalog of products to serve our merchants. Just so you know, we have blocks, business lines of credit. I've got some asset-backed programs where you do actually have to put up a building, a second home. We have the ability to monetize fine art, exclusive vehicles, jewelry, etc. And then I have unsecured capital, which is what most people are going to qualify for because of the broad brush, because of the credit score requirements, the time and business requirements. So I do have a full catalog of products to service our merchants' needs, but we do specialize in term loans, merchant cash advance.
Yeah, and I think that that's the coolest thing. Like, I like that you do a lot of the stuff. I think that fine art and jewelry and cars. I think it's unique. That's such a unique thing. You just don't hear that a lot of business owners offer that stuff, right? So I think that that's all right. You don't see lenders that offer that kind of option, and that's one of the things I love talking about to you before is that you have so many different options. Like with you internally, you've got the ability to be able to lend money based on revenue, asset-based lending as well. You've got lines of credit, you've got loans, you've got other options on top of that. And then that's just in-house. And then to your point, if you can't do it, then you're able to go outside of you and you've got other connections where you can connect people. So it's just like you have so many different options to be able to fund somebody versus if they don't fit the small box. Even people in the fintech revenue space, they're just out of luck. And I love that you have so many different options to help an entrepreneur solve that problem.
And Ty, really what separates Dynamic Capital from probably all those other people you spoke of is our relationship with the merchant itself. It's what as I said, we go ahead and farm, nurture, build, and develop that merchant because most of them renew. About 85 to 90% of my merchants are going to renew with me at least 3 times this year. So it's that relationship that I have directly with my client that allows me to kind of navigate which product is best for them at which period of time. Now, there's some merchants who want a line of credit, but that's not actually the best product for them. So once we understand their true use of proceeds, their timelines as far as when they need the money and when they want to pay it back, it allows us to direct which product would fit their needs the best.
Yeah, and I love that because and that's one of the things I wanted to ask you, because when you start at 25K and go to millions, then you're basically talking about a business model where you're growing with that business. You're able to get in the very, very, very starting. And you and I both know that most people in the anybody in the revenue space or merchant cash advance space, they don't go as low. They're not even offering 25K. They don't even want to talk to business owners unless they've been in business 1, 2 years and make, a lot of money. So the fact that you're this low kind of tells me that you're getting in with somebody even when they're just kind of when they're showing they have momentum and they're showing they can run a business, and then helping them get the capital they need through those stages to be able to grow to, multi-million-dollar businesses.
That's where the relationship starts. When you see a smart merchant who has got a good business, and you start to give them and invest in them through capital, they're a long-term client because you did something for them that everyone else said no to. So 3, 4, 5 years down the road, they're still in our portfolio working with us
And you said they come back on average, what, 3 times a year?
on average. Yes.
That's a lot of funding. And I think that's so cool because that means that they're growing. They're taking your capital, they're growing, you're making the right call with who to lend to, and then you're giving them more capital to continue that growth, continue that guy. It's just like the coolest thing in the world. Like, I don't know about you, but like I like to just everybody tells me what they do, and I'm like, I want to do that. And then somebody else tells me, I'm like, I want to do that. Like, I want to do all these cool things entrepreneurs do, but then try to stay focused in my lane. But it's like being in the lending space and in the educational space like we are, it's like you get to be a little part of that journey. Like you get to see these people go and have an idea and they're kind of getting momentum, and then you fund them, and then you watch it set on fire, and then you just continue to watch it grow. It's like the coolest feeling ever.
It works for both parties. Why? Because one, when someone comes in doing $40,000 gross rev, you're able to provide them 40,000. Right now, go as they grow to 60, 80, 100,000. Now we're able to provide them a larger dollar amount. They're able to grow it at a maximum speed, and it just is a real nice symbiotic relationship.
Yeah, I love that. I love that part of what you do. What kind of terms you offer on the financing?
So we get as creative as we need to be, just so you understand. So we've done deals like the guy only needs the money for 2 weeks or 3 weeks. So what I typically do is I'll structure something because of the way our payments work. If it's a 2 or 3 week payment, we blow them out of the water on payments. So I'll structure something, let's call it 10, 11 months for the person with an accelerated payout discount. So they're exiting me in the teens and they're not getting beat over the head with a long-term rate.
It makes sense. So, do you really look at then, is it more like common sense lending? Like when somebody comes in, are you really looking at where they are and what they're trying to do, and then figuring out the right kind of product, the right kind of term, and all those details from there?
So when files come into us, as I said, I was an early adapter of AI. Immediately, I use an AI bot that kind of reads the file and it'll grade it out for us, A, B, C, D, and then it'll kind of tell us direct which product would be best. And then my humans will go ahead and grab the file to kind of speed up the entire process, and it kind of eliminates any waste or more importantly, because of the bots, because of the speed, we've kind of been able to really collapse our overhead and cost, and we're able to pass those savings on in rate to our clients. And that's really one thing that was super helpful for us. But when the files come in, they get rated, graded, and then from there, a human will take over and determine which product and which program is best for them.
Yeah, I love that you're incorporating AI to reduce overhead, reduce costs, pass that on to the client. And I love that you're an early adopter of that too. It's phenomenal what that's done for our industry and being able to give us the ability to offer more options to clients, or the right option. Where do you see it going? Like, out of curiosity, because you're building some cool sales tools and stuff I want to have you back on the show to talk about. So where do you see AI going in the lending space? Like, where do you think from where we are to where it will take us?
So it could go the full spectrum, just so you understand. Um, it, Most people, larger firms right now have an AI outbound sales bot that's actually going out and cold calling on behalf of them, bringing leads. They have AI. If you look at the AI bots on websites right now, we have one that captures everyone that comes to our website, has great conversations, train it once, and it never makes the same mistake. So will AI enhance our business? Yes. Will it speed things up? Yes. I think it would also condense some of the mistakes that are made, but it will not replace the human in total. Most offices, Ty, I'm sure you know this, have an 80-20 performance. 80% come from the 20% performers. Well, those 80% who aren't performing are going to be eliminated. It's just going to be, in my opinion, the elite salespeople and the elite HR people and the elite managers who are going to stay, and everyone else may get pushed aside.
Yeah, it's gonna be interesting. Hey, Steven, I appreciate you coming on with us today. I love what you're doing. I think it's so creative. I mean, I've talked to a lot of people. I've never known anybody that combines the funding products you offer or the model you have where you're able to offer so many different solutions and then have relationships downstream if somebody doesn't qualify, that you're able to then bring somebody in to be able to help. I also really admire the fact that you're dealing with not your necessarily only early stage business because you help them grow, but getting in on such an early stage and then helping them continue to grow to higher levels. The people that are watching this that want to apply, that want to talk more to your team and be able to get into this process to see the funding they can get approved for, where should they go? What should they do?
You can find me all over the place on all the social media channels. I'm at Steven Edisis. You can find me here on Instagram and Facebook, the Steven Edisis Show on YouTube. And if you're really looking to get serious about growing and expanding your business, you can reach us at our website. It's dynamiccap.com. That's www.dynamiccap.com. And one of my amazing agents will be happy to answer any questions that you have and kind of give you some guidance along the way.
Steven, thanks for coming on with me today.
Hey, Ty, man, I look forward to seeing you again. Thank you so much.
Yeah, appreciate it. So listen, there's a few things you want to do. First of all, you want to follow Steven online because this isn't what he does. Well, it's pretty cool. He's incorporated AI at a very early stage. So as a result of that, he's built tools internal. But now, if you keep an eye on what he's doing, I don't want to be the one to reveal anything to you, but you might see that he's taking some of these tools that have helped him build a very big business and putting them out in the space that you might be able to actually learn about and be able to incorporate into your business as well. But you're only going to know this if you're following him on social. So make sure you look him up online. And again, that's Steven Edisis, Edisis, and it's Steven Steven. I don't need to tell you because you can look at it. It's like literally right behind it. So make sure you check him out on the social, follow him on the social channels. You can see what he's up to. And then also make sure you go to dynamiccap.com as well. Dynamic Cap just makes it really easy if you go to their website to be able to apply. While you're there, take less than a minute, go to the bottom of the page and just subscribe on their social channels. Because again, you're talking about an early adopter of AI. What does that mean? What it means is that they're using technology very early into the process, not just AI, but they're paying attention to what's going on and then adopting it very early. So you want to be able to follow somebody like this because that means they usually have the most financing options. They have the better options for you. And then on top of that, they're able to take technology and take these advancements that we're seeing and be able to incorporate to give you a faster, easier, better, and really more affordable experience. But you can check it out for yourself at dynamiccap.com. Go to the bottom of the page, subscribe on social. While you're at dynamiccap.com, you can check out the funding products. You can look right there on the homepage. You can even find revenue-based financing. You can find lines of credit. It's really easy to apply. And Steven just walked through with you like how fast this process is. I mean, how quick they're doing a review using technology and humans to be able to find the right product and to be able to get you approved, even in a situation where you're not going to get approved for traditional financing. In my opinion, even in a situation where you're not getting approved for a lot of alternative financing you're finding online. And that's one of the reasons I wanted to have Steven on, is because you might think that, hey, there's no chance because I got denied at Bank of America or some other place that denied you. But the reality is that here you've got an opportunity to probably get approved when you weren't able to get approved, or you think you might not be able to get approved because you have other barriers in your way. As long as you're running a make sense business and using the money to be able to grow, this is a company that could be with you from the very early stage until you get to significant growth. So make sure you check them out at dynamiccap.com, and also make sure you find Steven online as well. Thank you very much for tuning in. Take care and have a great day.